Hi everyone, Donnie Schultz, Embrace Home Loans here with your weekly rate update. So Friday, March 25th, a little bit after 5 p.m., we are finishing up another rough week for interest rates and bond markets. We have been under continued pressure, a little bit of a pullback on Tuesday, another head fake. We've been seeing that for the last couple of weeks. End of the week, rates have been pulling back, and then Monday it's off to the races and they're moving higher. So last week we were talking about a potential top to this interest rate move. We were going into some key targeted resistance levels, mainly 2.4%, 2.42 on the 10-year Treasury. We did test that on Monday. Rates pulled back. If we were talking Tuesday, I'd say, hey, again, we're targeting that top. It's really showing as a top. And then Wednesday, we blew right through it. Thursday, weakness. Today, a lot of weakness. Over the last 3 weeks, interest rates on most programs are up over a full percentage point. So 3 weeks ago, we were locking in 30-year fixed rate mortgages at 3.75%. Today, we are locking them in at 4.75, 4.875. If this holds Monday, a lot of lenders will be showing 5% on their rates. You told me that we were going to be talking about 5% interest rates in March, April of 2022, back in December. I would have told you were crazy, but this is the situation that we're in, and we're in it for a reason that we've been talking about since early January, which is the Federal Reserve shift to fight inflation. Federal Reserve came out again this week and really just emphasized how aggressive they're going to be. The next two Federal Reserve meetings are guaranteed 50 basis point increases on the federal funds rate. Those are the rates that impact your credit cards, your HELOCs. Those are going to be going up. The next 2 months, you are going to see a full percentage point increase on those rates. You have a home equity line. It's going up a full percentage point, possibly more. We're starting to see whispers that the Federal Reserve might increase by 75 bips. All right. So, markets, especially bond markets, treasury markets, longer term interest rates are trying to get to a reconfiguration of where they feel they need to be because of this aggressive policy. So that's why we just see continuous increases in rates. It seems like daily rates are going up an eighth. Where does it stop? Again, last week I was hoping that we were seeing a top. This week I'm a lot less confident in that. Based on the movement we saw today, the resistance levels that we broke through, the Federal Reserve coming out and their members telling markets and projecting to markets that, hey, we need to be prepared. I think that the most likely top on 30-year fixed rates is going to be in the 5.5% to 6% range. It's tough to say how long it's going to take us to get there. If we move at the pace that we've been moving at, it could be as little as 2 to 3 weeks for us to get to that point. It could be a week. We are moving quick. We are moving fast. At some point, it's going to stop. Listen, we can come in Monday and this last resistance level that we've been testing all day today, that could hold and we could start reversing. That's possible. Lenders need to be nimble. Buyers need to be ready. The big question right now is, what does this do to housing? So we're dealing with two things right now with housing. You guys on your side know that inventory crisis. We've been talking about this for years. This year, it's exasperated more than ever, but we have an inventory crisis with values going up because there's not a lot of homes for sale and we have buyers. Are homeowners going to be more likely to sell their properties that they have fixed rate mortgages locked in at 2.5, 3, 3.25, knowing that they're still going to be paying a high price for the next property, and now they're also looking at rates that are above 5%, potentially 5.5%, 6%. That's my concern. Do these buyers say, hey, I'm going to stand pat, I'm going to wait this out? Values aren't going to be impacted because we're still going to have an inventory problem. We'll still have buyers out there who want that limited inventory, but are there going to be less and less homes for sale as these rates push higher? It's going to take months to play out. We're already starting to see it in the housing numbers. Pending sales has been moving lower at a point where we would expect it to start increasing. Is it seasonality? Is it the winter months? We're not in the spring market yet. It's really tough to say, but that's the big concern. I think right now the focus is just making sure that buyers have updated pre-approvals, they have updated numbers, they know what they're looking at. These properties are still falling in their budget goals. There are going to be buyers who have pre-approvals from a month ago that no longer qualify for the homes that you're showing them. So important to reconnect them with the lenders. If anybody needs detailed numbers, if anybody wants to talk, if any buyers are concerned, me and my team are here to help. I hope everybody has a great weekend. Talk to you soon.